This is episode 79 of Zen and the Art of Real Estate Investing with my guests. Yes, another two-person show, Brady Slack and Mike Scicluna. They are the founders of High Country Finance. They specialize in helping business owners, independent contractors, entrepreneurs, and real estate investors reduce their tax bill and elevate their business and personal wealth. Mike, Brady, welcome to the show.
Thanks for having us.
Yeah, excited to talk to you guys. It's always good to have a tax-friendly episode because there's lots of investors like myself who've just been blundering themselves through the years. Let's actually just start with a quick question about taxes. Where is the biggest place that people are making mistakes as real estate investors right now, in each of your opinions?
I think the
Tax-wise,
biggest
of
mistake.
course.
Mike might have a different answer. Yeah, go
I
for
was
it,
gonna
Mike.
say, I think the biggest mistake is trying to read the market and play the market in real estate, and then trying to use that. And then on the flip side, trying to use real estate just for taxes. I think that taxes can be a huge benefit, but you've got to do real estate when it makes sense for your financial journey, not read the market and not just try and save taxes this year, because it's a tax deferral, not necessarily a tax elimination that you use with real estate. So I think people are going to listen to their CPA sometimes and say, oh, well, let me just go buy assets that I can depreciate. That depreciation can come back to bite you in the butt if you don't do it right.
Yeah, I agree with that, Brady. I'll let you weigh in and then I'll throw in my opinion.
Well, I think I know where you're going to go with that, so that's okay. I'm actually kind of surprised Mike didn't say what I was thinking. I think one of the biggest deficiencies that individuals have when it comes to real estate and taxes is they don't pay close enough attention to the actual accounting or entity structure. And I think without knowing it, that comes back to bite them when they don't have all the deductions that they could use to offset some of their rental real estate income, or they don't have the proper entity structure, which is maybe also having to deal with the legality of their structure. That I think those are some big problems that people run into.
I have friends who will say like, "Oh, I need to buy something to depreciate," and I just grew up with my dad saying like, "That's not a good idea," because you're kind of like exactly like you were saying, like you're forcing a purchase to create a depreciation that may or may not really work out long term, and then the asset still has to perform. Also, that's what you're talking about, right? I find this really harder in real estate. Before I get to Brady's point, like what type of asset are you buying that you can depreciate rapidly enough in real estate where it would make sense?
So a multifamily property, you can actually depreciate using a cost segregation, and Brady can talk a little bit more
Right.
about that. The tax savings on that can be quite significant. If you have something like a 16-plex, you can offset, up to upwards of $1 million in revenue, or in net income, really. But it's not worth it if you're losing money on the property. So if you were to buy a 16-plex and you're negative $2,000 a month, and you think, oh, it's negative $2,000, but I'm saving $300,000 in taxes this year. You're not saving, you're deferring. And if you're not making money on that property, then it's probably not going to be making sense. And that's, to Brady's point there, don't get into real estate just because it seems like you're going to save some taxes. You need to actually look at all the numbers. And this is where, this is what I spend a lot of my time doing is ROI analysis of investments. If you're looking at putting, let's just say $1 million into a property or something like that, you need to look at the future value of that cash. And if the future value of that cash compared to the present value is not going to at least give you a 10% return, then you're not even doing better than the stock market. And then when you do an ROI analysis, you take into consideration the depreciation and the tax savings, then you take into consideration the revenue that you're making and maybe some expenses that you're saving on in a business. You've got to be making good amounts of money on an investment like that when you're looking at the future value of the cash compared to the present.
Brady, let's talk a little bit about entity structure because you brought that up. if you look across bigger pockets, probably the question that's asked the most is like from a baby investor who says, should I start an LLC? So I
Yeah.
know that it's not as important as people think, but it is important. But you can't use an LLC for most parts to buy if you're using a mortgage, unless it's a community bank sometime. So where does the entity structure come into play that can help somebody long term?
Yeah, really great question. I'll preface the question by stating that CPA also stands for cannot protect assets. Like, so part of the entity question comes into play with a conversation with an attorney and your specific kind of plan or financial structure. But when we talk about entities, the biggest reason why we talk about entities when it comes to real estate, it does have to deal with the liability of a rental real estate property, and not because we like want to get sued, but it again just planning and protecting ourselves. Now, again, I'm also not a mortgage lender. I'm not in title. However, the majority of our clients are able to set up an LLC sometime in the closing or shortly thereafter, and with a quick claim deed, assign that property to the LLC. I will speak on the fact that the reason we use LLCs in when it relates to real estate has to do with the fact that it's an asset. The property is an asset, and if you own that asset in a C corporation or an S corporation and try and sell the asset or perform a 1031 exchange, you have no basis in the asset, which could cause unintended tax consequences to the basis or the shareholder basis of that stock in the corporation. Whereas in LLCs, I can sell property, transfer property without causing any changes to a basis in stock. Um, the other thing I'll mention, it's funny, I had this conversation I'm looking at my calendar, 2 hours ago with another client that we were going over entity structures, and they're purchasing a couple properties before the end of the year. And the other question I get is, how many properties should I put into one LLC, or do I need multiple LLCs for every property? And there are some situations where you would need a separate LLC for a separate property. I have some clients who own multiple properties, 10, 12, 15 properties with one LLC, and that's fine. They understand the risks that would be associated with that when it comes to liability. And then I have some clients who maybe own a larger property like what Mike was talking about and separate that into its own LLC because it comes with its own equity and risks. And then they invest multi-state, and each state has a separate LLC for the properties that they own. But again, it's a team effort, right? You talked a little bit, we podcast swapped, Jonathan, but we talked about your team, last week in our conversation. And it's important to have a team. It's important to be communicative with that team. And typically in that team is going to be your accountant and an attorney to help you walk through what that process should look like as it relates to you.
They might want to rewind and go again, because like it's important to figure out. And like you said before, Brady, like this is a conversation for you to have when you're building your team, and part of your team is a tax professional who can help you, but you have to let them know in advance, like Mike said before, of what you're planning, so you can make sure to at least maximize the benefits or understand, if you do make this purchase, what could come of it. Let's talk a little bit about that real estate professional. That's always been interesting to me. I didn't really actually know about it, which is crazy because I probably could have used it to my advantage,
Yeah.
and still do not. But explain what you have to do to get it and who it's ideally suited for.
Great. Yeah, really great. I'm actually kind of shocked, Jonathan, that based on my knowledge of what you do, I'm kind of shocked about the real estate profession that is there.
Oh, me too.
Uh, so real estate by technicality is a passive income producing activity. Okay. Which means it has its own rules about what losses can offset incomes, and passive activity loss rules. But when it comes to real estate specifically, there are three ways that an investor can be classified. The first way is a passive real estate investor. Typically, this is someone who might be just putting money into a syndication or a fund and gets a mailbox money, every month or every quarter. That's how I typically see it. Then you have, and the tax consequence of a passive investor is you can only use those passive losses to offset other passive incomes. Maybe you have portfolio income, passive business income, whatever that might look like. The second type of investor when it comes to real estate is an active real estate investor. This is someone who has what the IRS defines as material participation in the activity, or they spend time in the business, whether that's managing the property, doing renovations, looking for new properties, whatever that might entail. And the benefit of being an active real estate investor is that you can use certain passive losses to offset ordinary incomes, whether that's W 2 income or business income. Now, there are some limitations to that. If I make over $100,000 in adjusted gross income, I start to phase out and I can only use up to $25,000 of those losses. If I make over $150,000, I'm phased out and can no longer use any of those passive losses against active income, just passive income at that point. And then there's the third status, which is this real estate professional status. There's a few different tests that you need to meet in order to be classified as a real estate professional. Typically, the most common or the most used in the examples as far as audit techniques go in the real estate professional guide are that I have to, more than 50% of the services that I provide during the year have to be in real property. Again, what is real property defined as? Property management, maintaining my properties, cleaning my properties. It could even be something as far as real estate, title, mortgage, construction. As long as if I'm a W-2, I own at least 5% of the company that I'm working for. So there's quite a few different opportunities there. And then typically the second test is that I have to spend at least 750 hours a year in the activity, as well as maybe some other hourly requirements for certain properties with property managers and things like that. The benefit of being a real estate professional is that all of my passive losses from real estate are not subject to passive activity loss rules and can offset any and all other ordinary or active income, such as business income or W-2 income. So that's a very powerful tool when used right.